Imagine waking up one morning to headlines claiming that the US government has quietly drafted a Bitcoin executive order, one that could change the future of digital money forever and yet nobody is talking about it publicly. What if the warning signs were always there, hidden in political speeches, regulatory memos, and national security briefings? What if history is repeating itself, just like 1933, when gold holders were blindsided overnight? This video begins with a simple but unsettling question. What if the government already has the legal tools and political motivation to come for your Bitcoin, and the public is the last to know? As global financial tensions rise and decentralized money challenges traditional power structures, the idea doesn't seem as far-fetched as it once did. In fact, the more you look, the more the pieces begin to fit. Bitcoin has gone from a niche experiment to a trillion-dollar asset that threatens the very foundation of government-controlled money. Presidents throughout history have used executive orders to reshape the financial landscape, often without public debate. And today, the political environment around crypto is more charged than ever, with regulators tightening control, intelligence agencies raising concerns, and central banks accelerating their push toward digital currencies of their own. The stage is being quietly set for a dramatic shift. In this video, we dive deep into the rumors, signals, and political currents that fuel the possibility of a Bitcoin-targeted executive order. This isn't about claiming a secret document already exists. This is about analyzing the real-world trends, legal precedents, and government strategies that suggest such an action is entirely possible. By the end of this investigation, you'll understand why many experts believe the battle for financial freedom is already underway, and why Bitcoin may be standing at the center of the next major power struggle. The origins of the rumor. Rumors of a potential Bitcoin executive order didn't appear out of thin air. They built up slowly through political statements, policy hints, and comments from key advisors close to the administration. Analysts noticed references to digital national security threats, unregulated money flows, and economic emergency powers. Add to that leaked regulatory discussions about tightening crypto oversight, and suddenly the idea of a sweeping executive order doesn't feel far-fetched. What begins as speculation often traces back to real concerns inside government circles. This chapter explores how whispers, signals, and quiet policy debates evolved into a widespread belief that something big may be coming. Chapter 2. Why the government fears Bitcoin. 100 words. Bitcoin challenges one of the government's most powerful tools, control over money. When people can move billions across borders without intermediaries, bypass sanctions, and store value outside the banking system, traditional institutions feel threatened. Officials publicly raise fears about funding terrorism, evading taxes, and destabilizing financial markets. But beneath those explanations lies something deeper. Bitcoin undermines centralized control. A currency that operates without permission changes the balance of power between citizens and the state. That fear alone can motivate governments to consider extreme measures, including executive actions. This chapter uncovers the true motives behind the escalating pressure on digital assets, the legal tools they could use. An executive order wouldn't need to explicitly ban Bitcoin to reshape the entire crypto landscape. The US government already holds powerful tools: emergency economic powers, national security authorities, and financial regulations that can be expanded almost overnight. A president could instruct agencies to restrict exchange operations, tighten KYC rules, demand reporting of private wallets, or classify certain types of transactions as high. None of this requires a vote in Congress. Historically, these powers have been used to control gold, foreign assets, and even banking activities. This chapter explains exactly how a modern administration could act swiftly and legally, how confiscation would work in 2025. Modern confiscation doesn't require agents knocking on doors or demanding private keys. Instead, it would happen digitally, through restrictions on exchanges, forced conversion rules, and freezing accounts linked to non-compliant wallets. Regulators could require all crypto to pass through licensed custodians, effectively forcing holders into the banking system. Heavy taxes, penalties, or mandatory disclosures could pressure people to surrender privacy or holdings. Governments wouldn't need to take your Bitcoin. They would only need to make using or withdrawing it nearly impossible. This chapter details how a digital confiscation could unfold while still appearing lawful and justified to the public. The role of CBDCs, central bank Digital currencies are a key part of this story because they offer governments something Bitcoin never will: total visibility and control. A CBDC allows programmable money, real-time monitoring, and instant enforcement of financial rules. If a government wants the public to adopt a CBDC, restricting competing decentralized currencies becomes a logical step. Officials often frame CBDCs as modernization, but behind the scenes they give the state unprecedented power. By introducing a government-backed digital dollar, authorities could justify tightening regulations on private crypto. This chapter explores how a Bitcoin crackdown conveniently supports the rise of a controlled digital alternative. Who benefits from a Bitcoin crackdown? A sweeping executive order targeting Bitcoin wouldn't hurt everyone equally. In fact, it could benefit powerful groups. Big banks gain control by becoming the only regulated custodians. Government agencies gain surveillance capabilities. Central banks eliminate competition for their digital currencies. Large institutions might buy distressed Bitcoin at lower prices, while retail investors face penalties or restrictions. Even political actors gain by strengthening their grip on the financial system. Whether intentional or not, a crackdown shifts power upward. This chapter reveals the winners in a world where Bitcoin falls under strict control and why those players may quietly support such policies. What this means for ordinary Bitcoin holders, for everyday holders, the impact could be severe. A sudden executive action could freeze exchange accounts, restrict withdrawals, or force compliance through complex reporting requirements. People who rely on exchanges for custody would be the most vulnerable, while self-custody holders could face new scrutiny, audits, or mandatory declarations. Market prices could swing wildly as fear spreads. Even if the government doesn't directly take assets, the psychological pressure alone could push many into selling. This chapter examines how ordinary investors from casual users to long-term holders might experience the shockwaves of a regulatory move aimed at tightening control over digital wealth. How people might protect themselves. While no one can predict exactly how future policies will unfold, people can take steps to prepare for regulatory uncertainty. Many investors explore self-custody, diversify their holdings, use multiple exchanges, or closely follow policy changes. Others focus on compliance to avoid legal issues, keeping records and understanding reporting requirements. Staying informed becomes a crucial defense. Some even study historical examples like gold in 1933 to understand how governments respond during financial stress. This chapter offers practical, informational strategies based on common investor practices, helping viewers think critically about protecting their digital assets in an unpredictable regulatory environment.